The Bank of Canada did not cut rates today, nor did they increase them. They held them steady. And a lot of people are kind of wondering why. With 84,000 jobs that disappeared in 1 month, oil pushing past $100 a barrel, well, the Bank of Canada, they can't cut rates and they can't raise them either. They're completely stuck. And if you have a mortgage or you're about to get one, these three things are about to collide in a way that hits your payment directly. We're going to break this down into three pieces. First, the job crisis and what it actually means for rates. Second, why oil at $100 a barrel makes everything worse. And third, the trap the Bank of Canada is sitting in right now and what that means for your mortgage journey in 2026. Canada just posted over 84,000 job losses in a single month. Outside the pandemic, that's the worst we've seen in decades. Now, normally when the economy weakens like this, the Bank of Canada's playbook is to simply cut interest rates to stimulate borrowing and spending. Lower rates means more activity and economic recovery. That's how it's supposed to work. But that playbook only works when inflation is under control, and right now, it's not. So what does this mean for you? It means if you were waiting for rate cuts to make your mortgage cheaper, you might be waiting a lot longer than you think. Here's the other half of the problem. Oil is surging nearly 50% this year, and every $10 increase in oil adds about 0.3 to 0.4% to inflation. Why? Well, because oil doesn't just fill your gas tank. It moves the trucks that deliver your food. It heats your homes. It's baked into the costs of literally everything you buy. Higher oil means higher inflation. Higher inflation means bond yields go up. And when bond yields go up, fixed mortgage rates follow. And here's where it gets really unfair. If you're in Alberta, you're actually benefiting. Oil economy is booming. Jobs, investments, revenue, all looks like it's going up. But if you're in Ontario or BC, you're getting hammered. Higher gas, higher groceries, higher cost of living, and none of the upside. It's like having two completely different economies inside one country with one central bank that's sitting on interest rates trying to figure out what to do when looking at both of them. So now you see the trap the Bank of Canada is kind of sitting in. If they cut rates to stimulate the job market and economic growth, they pour fuel on inflation that's already rising because of the cost of oil. If they raise interest rates to fight inflation, they crush an economy that's already bleeding 84,000 jobs in a month. We've lost around 100,000 jobs in a very short period of time. So what do? Well, just like today, they do nothing. They hold at 2.25%. They do absolutely nothing because every option makes things worse. It basically means rates aren't coming to the rescue. Not this quarter and probably not this year. Now, let me show you what this actually looks like with a sort of scenario. If you have a $420,000 mortgage and you locked in at 2.09% during the pandemic, now you're coming up for renewal, and let's say you've lost your job. Your old payment, roughly $1,800 a month. But now we're up for renewal and we're getting new rates, and let's say around 5.4%. We're going to budget on the high side. Now, the new payment on this, that's going to be about $2,350 a month. That's an extra $550 more every single month, and you just lost your income. And the thing about this is actively happening to people. 1.15 million mortgages are renewing in 2026. About 60% of all outstanding mortgages are resetting at higher rates. And mortgage arrears, especially in places like Toronto and BC, are already starting to climb. This isn't a forecast. It's happening actively right now. So here's what you actually do about it. Number one, if your mortgage renews in the next 12 months, start the process now. Not when it's due. 6 months minimum. Get in touch with your lender, get in touch with your broker, explore options. Number two, get a rate hold. Lock in an approval at today's rates while you still can, because if oil keeps climbing, rates are going to go with it. You can generally get a 90 to 120 day rate hold on mortgage rates. So make sure you're proactive in looking at them. Number three, if you're employed, get your financing locked in while you have income on paper. Qualifying gets a lot harder if you lose your job, and make sure your budget is tight. Number four, don't bet on rate cuts. Hope is not a mortgage strategy. And honestly, we might not see rate cuts for a while. You're going to want to budget and make sure things are working with the rates you have. And number five, be cautious around variable rates right now. In this environment, the certainty of a fixed rate kind of has some value to it. Now, I'm not saying shy away from the variables. There are still a lot of cases where they make sense. You're going to want to look at the variable and say, do I have a buffer? Now, as a little bonus strategy here, this is what I do generally when looking at variable rate mortgages for customers. If your variable rate is sitting at, let's say, 3.5% and the fixed rate is at 4%, that means your variable would have to go up by half a percentage point before it would reach the cap that the fixed rate that was being offered is at. Is prime going to go up by half a point? We don't generally know, but there's a lot of economic data that shows that it probably won't go up by a half a point. So in that case, the variable still might make sense. However, if you're going to lose sleep at night taking that variable, maybe look at the fixed rate. Because honestly, if you value that security and it makes sense at that higher interest rate, that's the option you should take. The economy is sending two opposite signals at the same time, and the Bank of Canada is stuck right in the middle. Rates may not come down, even as the economy weakens. That's a reality. And if you have a renewal coming up or you're trying to figure out what this means for you and your specific situation, I'll link a video right over here where it walks you through a full 2026 rate forecast and prediction. Watch that next. My name's Myles Nowik of the Nowik Mortgage Team, powered by Indy Mortgage. If you got value out of this video, make sure to like and subscribe. We'll see you on that next video.